Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special investment report. Today we have news just in that the ANZ Bank in Melbourne has issued a major profit warning. It says its cash earnings per share are likely to fall 20 to 25% this year. That's because it expects a $1.2 billion loss on its loans across both Australia and New Zealand. And that includes a tripling of provisions for loan losses for individuals in New Zealand. ANZ, which owns ANZ here and National Bank, says the New Zealand economy is contracting and credit growth has essentially stalled. It says stress on household incomes because of high inflation and high interest rates is hitting customers here, and some of them aren't able to pay their interest. New Zealand's profit from the ANZ group is likely to fall 5%, says the ANZ. It's got a good corporate result, this is for big businesses, and that's offsetting lower profits from consumers and from businesses. Meanwhile, the National Australia Bank, which owns the Bank of New Zealand here, has announced it will have to take an $830 million loss because of some investments linked to mortgages in the United States. It bought some collateralized debt obligations, CDOs, nowadays they're known as toxic bonds, and has had to write off 90% of their value. In part because even though this was a AAA rated bond, it turns out 45% of the people who took out mortgages that went into this bond, they're not paying off those mortgages now. That shows how seriously the collapse in the US housing market is affecting the market there. So National Australia Bank has taken an $830 million loss on that. And now Standard & Poor's, the rating agency, has put the AA rating that National Australia Bank has on outlook, negative outlook. And now that has affected the rating for BNZ here as well. That also is AA rated, but the outlook now is negative, according to the Standard & Poor's. I'm Bernard Hickey. That was a special investment report for interest.co.nz.